This is how trading firms sell options using the volatility risk premium. Volatility risk premium or VRP is simply implied volatility subtracted by historical volatility. Now, implied volatility is the market's expectation of an asset's future volatility derived from its options price. Basically, it's the volatility levels that the options prices are implying, and realized volatility or historical volatility is the actual observed volatility of an asset in the past. Historically, for an asset, its implied volatility is most of the time above than its actual historical volatility. If you look at this Microsoft chart, you'll notice the red line, which denotes the asset's implied volatility, is most of the times above the asset's actual historical volatility, denoted by the green line. The difference between this implied volatility and the realized volatility is called the volatility risk premium. Now, why does this happen? This happens because markets often fall faster than they rise. Stocks can drop 10% in a day but rarely gain that much. So, investors are constantly afraid of sudden crashes and they buy options to protect their positions. This demand for options pushes the options prices slightly higher than usual, which increases implied volatility even though the asset's actual volatility might not be that high. Now, as you can see in this chart, when the volatility risk premium or the difference between implied volatility and historical volatility is unusually high, represented by these green areas compared to the average of 3.13%, it suggests that the options may be overpriced here. This creates an opportunity to sell options because over time the implied volatility tends to revert back towards the actual volatility. This idea of selling options when volatility is overpriced is the foundation of VRP based strategies. Professional firms use more advanced version of this with different implied volatility maturities, volatility forecasting models and strict risk controls. But at its core, the simple gap between implied volatility and realized volatility is what drives professional option selling.